Good morning, traders. It's Monday, 19th of March 2018, time like every day, real-time daily trader ideas. We will speak about market screening, strategies, and maybe one or two questions from your side directly answered in the webinar. Our goal is quick and smart, but for this daily, so let's have a nice start. 5 days a week, 5 different traders. Welcome to anybody. Like all the time, we will start, of course, with our risk disclaimer. Forex and CFDs are leveraged products and can result in losses that exceed your deposits. If you're a starter, please start with a demo account and make yourself familiar with long trading, short trading, and your personal risk management. If you'd like to read the full risk disclaimer, just visit one of our web pages, for example, admiralmarkets.com, and you will find everything displayed there. This is me. I'm talking from the Berlin office from Admiral Markets. We are a big international broker with over 18 country offices, so I'm the German guy. My English is made in Germany, but hopefully some of my quality too, but I'm not the main speaker. The main speaker is the day trader of today. Today it's Monday, so in a couple of seconds it's Jay's day. On Tuesday it's Paul's day. On Wednesday it's Giancarlo's day. On Thursday it's Sinat's day. And on Friday it's Dirk's day, our leading day traders live. And of course, if you like to trade Forex and CFDs, you will get many benefits only with Admiral Markets. For example, one of our bestsellers, DAX 30 CFD triple spread of just 0.8 points. Choosable leverage, MT4 or MT5, and many, many things more. Check all the benefits out on admiralmarkets.com. There you will find also something about our regulatory background and also how to contact us, call us, or send us an email, or visit the other channels like YouTube or Facebook. Everything is linked from admiralmarkets.com. And this is the day trader of today. Hi, good morning, Jay. Now it's your time. What is your view to the market today? Hi.
Good morning, traders, and happy new week to all of us. Monday again, unbelievable. So let's show screen number 4 out of 8. And okay, so you can see my pick. Let's get going right into it. I hope you're all feeling well. Last week, if you may recall, we were longing the Aussie US dollar. We had some confirmed exclusion from US tariffs as an underlying fundamental driver for the Aussie to see some strength. And then we had some weaker inflation data expected out of the US, and the trade performed well, except that in this account, our buy limit was not triggered. Bad luck for this account, but hopefully some of you made some money. What I wanted to point out is that often these target lines that we put into the charts are not there for no reason. There's some logic behind it, and as you can see, the market did turn around on Tuesday, hit into that liquidity, and then strongly sold off. And this morning, we are seeing some weakness across the commodity sector and some risk-off sentiment, even though Asian equities were mixed. So it's not pure risk-off. There's some risk-off sentiment to it. And then, of course, it's the year-end, fiscal year-end in Japan in this during this month of March, towards the end of this month. So we continue to see some inflows into the Japanese yen. It's kind of difficult to short the yen during this fiscal year end, which will probably accompany us until the end of April, just so you know. And then money flows out of Japan again and into foreign assets because there's no yields to be made over there. Anywho, risk events starting this week. We have quite a lot on the docket. We have the Aussie dollar monetary policy meeting from last time. We have tons of central bank speakers. Then we have over in the UK, the consumer price index data coming in expected a little bit weaker than last time, but overall that economy is doing quite well. Continued on Wednesday, we have earnings index, average earnings index, that is super important, expected to tick up a little bit. So we are hearing some voices out of the UK economy, out of the employment sector, stating that they probably need to pay up a little bit in order to get qualified workers. Unemployment rate expected to remain unchanged. We have some current account figures out of the US that may be of interest due to the trade wars that are popping up on the horizon. Hopefully that is more saber wrestling than real action, because trade tariff wars do not really help anybody. Then on Wednesday as well, we have the Fed. There's a over 90% probability that they're going to hike. We have a press conference. It's going to be Powell's first press conference, so all eyes and ears on Mr. Powell. And then over in New Zealand, we have the RBNZ rate statement. More towards that in the following slides. Thursday, Aussie dollar unemployment rate and some labor data, important for us. And then in Europe, we have manufacturing PMI and services PMI. The first reading, that is called flash. That's the more impactful than the second reading, which is the revised one. And then again, more numbers and headlines out of the UK with the Bank of England's bank rate decision and retail sales expected to come in stronger. That's going to be of interest to us. And then on Friday, we have in Canada CPI and retail sales. That is also of interest. Very strong Canadian dollar last week. Very weak Canadian dollar last week. Okay, let's see if the computer wants to play along. Yep, here we go. Let's be quick, but go into some detail, because I also always want to explain a few of the vocabulary to you guys and give you an insight into what the institutional fund managers and bank traders are looking at. So the Fed, 94.4% probability that they're going to hike by 25 basis points, and all ears will listen to Mr. Powell during his first presser. The question is, how many hikes will the FOMC project during 2018? They give out projections during these press conferences. So currently the FOMC is projecting 3 hikes, and the market is pricing in 3 hikes. But how many hikes during their forecast horizon? And you may know that their forecast horizon is until and through 2020. And the FOMC is projecting 7 hikes, but the market is pricing in only 5 hikes. So what happens if a dovish Fed speaker hits the microphone, a dovish Fed speaker, and he or she talks hawkish? That then would mean that the market will listen to this wording very carefully. And once the market starts pricing in more than 5 rate hikes during the forecast horizon, the dollar will react to it by increasing in value. Okay, so that's why this is so important. Then where does the FOMC see the so-called long run rate? And currently they're seeing it at 275 to 3. So if Powell were to say something different here, higher or lower, the US dollar would react to it accordingly. Arguments for what we call an upward revision rate path. So what would or could cause the Fed to project more rates in the future? We have late cycle, economic cycle, late in the game. Trump came out with his fiscal stimulus plan. Little stupid to do the tax deal that late in the cycle, but hey, it's definitely positive stimulus. Then we had, especially in January, wage growth pressures confirmed. Then we have headline CPI above 2%. For the guys who may or may not be new to our morning meeting, it's very fundamentally based, because that's what drives currencies in the long term and in the short term and in the medium term, next to sentiment. And it's all about economic growth and inflation expectations. So the headline CPI is above 2%, although core CPI and core PCE lag. Core usually means X, so without energy and food as an input variable, okay? The PPI, so that's what goes into the production value chain, hints at inflationary pressures in the pipeline. Some of the PPI costs will be handed on to the consumers. Not all of them, but some of them. That is why the Fed looks more towards the consumer price index and not so much, but also at the producer price index, okay? So if input variables, input costs rise, some of that can be passed on to the consumers, but not all of it. Arguments against an upward revision to the rate path. The latest year-on-year rate of wage growth, and we had that last Friday in the ESI employment situation report, that was a lot weaker than in January. Okay, so that speaks against an increase in rate hike path. Impact of any trade wars. We are very, very interested in what if Powell mentions potential trade wars. That will be of super significant importance. Pound, on we go. Tuesday, we have CPI year-on-year, 2.8% is expected versus 3% last time, and the core measure is also slowing a little bit. So that would imply a weaker pound, yeah, the currency I mean now. 2.8% is also below the Bank of England's forecast of 2.9, which they gave out in the February quarterly inflation report, QIR. Rudy, for example, and Andrea and Atze, they've been following this morning meeting for a few weeks now, or since inception, and they know that when the QIR comes out, we are very eager to look at what the Bank of England gives us in terms of their forecast, their inflation forecast, because the currency reacts to it. Billions and billions of monies actually exchange hands on the base of these forecasts. That's why it pays for you to get to know your central bank. Wednesday is the average earnings index. That's expected to come in a little bit higher with 2.6. And so I alluded to it early on, some pressure on firms to lift pay. And then the employment is expected to increase again, but at a slightly slower rate than the 88,000 that we added last time. And then Thursday, the official bank rate, it's expected to remain unchanged at 0.5%, but the focus will be on the vote split, if any dove turned into a hawk and vice versa, and if the monetary policy summary gives us any inclination in terms of updated forecasts. Okay? Then on Thursday and Friday, we have the EU Council meeting, and there is some chatter that Britain and the EU will define certain Brexit terms as well as a transition period. Now, the market hates uncertainty. If this would actually lead to some kind of transition period being agreed upon, certainty would come back into the market. US companies would feel a lot better about their future investments and what the future may bring. And that would then lead to pound strength. And we're seeing a lot of pound strength this morning already, okay? You may have noticed that. Okay, so I'm clicking the button. It's not doing it. Here we go. New Zealand. New Zealand, as you recall, we have the rate statement and the official cash rate, but it's expected to remain unchanged on 1.75. The market is pricing in the next hike in New Zealand for middle of 2019. If economically any numbers come in stronger than expected, then that may be pushed forward, and this kiwi, the currency of New Zealand, would actually appreciate in value right away. Now, we expect that the bank, the RBNZ, will maintain the forward guidance. Recall that their fourth quarter GDP only rose by 0.6%. The RBNZ actually expected an increase of 0.9%, and the market, most of the economists expected an increase of 0.8%. So there was some weaker economic growth in the last quarter of last year. On top of that, the labor market data actually showed a 4% rate, and the NAIRU estimate by the RBNZ in the third quarter was 4.7. Now, listen up. Now I'm going to teach you something. The NAIRU is the non-accelerating inflation rate of unemployment. This is what professionals and the central bank look at. This rate in the third quarter by the central bank expected at 4.7, coming in at 4.5 in the last quarter, lower than expected. This rate refers to a level of unemployment within existing economy that does not cause inflation to increase. So this rate coming in lower than what the bank expected actually means deflation in terms of wage pressures or non-wage pressures. That's not good for the kiwi. That is not good. That is bearish for the kiwi. On top of it, the new governor starts on March 27. So the central bank has a new governor, and they are expected to employ a new policy targets agreement. And now, beginning of last year, beginning of this year, we actually talked about this, that this new agreement puts the labor market in the central bank's policy consideration, specifically this rate that I just explained to you, the NAIRU. So there could be a case for tighter policy in the months ahead, meaning the mandate of the New Zealand Central Bank is expanded. We talked about this last year already when the new government came in, and they said on top of an inflation target, we are now giving them an unemployment target. This is new, okay? And I'm expecting weakness for the New Zealand dollar for this week. Aussie dollar. Tuesday, we have the monetary policy meetings from the last meeting, which was March 6th. And you may recall the central bank kept the rates unchanged at 1.5%. Then we expect firmly neutral bias, and then the board were confident that inflation will move to within the target range. Thursday, we also have employment change, and that's expected to be strong. 20,300 versus last time 16,000 jobs added, with the unemployment rate holding at 5.5%. Fundamentals in Australia in the economy remain sound, and the leading indicators, particularly profits and employment readings from the business surveys, suggest ongoing jobs growth. So that's good. And the last economy that we look at real quick is Japan, because on Friday we have national core CPI expected to tick up on a year-by-year basis to 1% versus 0.9. Energy inflation is expected little change from last month, as continued moderation in prices of, you guessed it, electricity and gas should have been offset by a pickup in gasoline inflation. So those will null each other, but a jump in hotel charges and package tour prices should have lifted core inflation. So economists actually look inside these numbers, and they figure out exactly what's causing a price jump. Now, if you're an equity investor, obviously you would look at hotel change and package tour providers in Japan, because if they can charge higher prices, their bottom line may increase. So all markets are connected to each other. Okay, seeing diminishing support for Prime Minister Abiy following the recent land sale scandal. That's the last headline. I wanted to put that in because if you may or may not recall, there was a big headline last week about this land sale scandal, and his support is dropping. That's not good. What do we see in terms of commitment of traders? We already talked about it. It's nothing changed. No extreme positioning in terms of dealers, except and outside of the Japanese yen and towards fiscal year end in Japan, i.e. right now, that is absolutely expected. We've already undercut extreme levels from last year. Volatility is creeping back into our markets, which is nice. So the euro vol increased a little bit in Chicago in terms of the futures market, the pound volatility, the yen volatility, and the VIX. They're all rising slightly. That's good because that means volatility can make us money. We love volatility. Option pricing, what do the market makers tell us? They tell us short for Monday, and the Aussie came under pressure already. So these guys, this is derived from Monday's pricings, from Friday's closing pricings. These market participants, smart as they are, had a good lead on the sell-off in commodities that hurt the Aussie dollar this morning. Option flows, bullish on Monday London session, the pound, and the pound went through the roof already this morning, and bearish Monday London session, all else, basically. Good, so short pound, a long pound, short Aussie could be one trade, for example. But we are looking at the following trade. We're looking long pound versus short New Zealand, because I expect some weakness for the New Zealand dollar this week. We have CPI that's coming, that's expected a little bit weaker, average earnings coming in potentially a little bit stronger, retail sales expected stronger, and then we have the policy summary. So I'm interested in some positive arguments in there for the pound versus the unchanged expected rate statement, the increased mandate of the RBNZ over there, and some pressure. We are already long a starter position in this account for Admiral Markets, and we have two levels identified to add to the long. Risk for the trade is, of course, negative Brexit headlines during the EU Council meeting this week, and or strong sentiment, risk on sentiment, leading to inflows into longing carry trades. And the New Zealand dollar and the Australian dollar are prominent carry trade currencies. This is what the trade looks like on the chart. And because we didn't do it last time, let me check time. 21 minutes. Let's give it a few more minutes. Let's work in the chart a little bit because we haven't done that in the past. Because technical analysis takes us 2 minutes. So what the retail trader does most of the day, we spend 2 minutes on that. Everything else that you see, that's what we spend time on the institutional side. GDP growth, higher, stronger, lower, inflation expectations, increasing, decreasing. That's what drives big money, not technical analysis. Okay, so we start on the weekly chart, for example, and what we can do is we, let me take this off. So we'll show you how we do it. It's so slow, unbelievable. So what we do there is, come on, buddy. What we do there is we take horizontal lines and we just pump them right where the last swing is. Do you see these are called Bill Williams swings or fractals? In any MT4 platform as an indicator, you can push them in there. Why am I not using this fractal? Because the market's already here. So I'm using one fractal higher, and I basically put the line where the body hits the candle. And trust me, I'm not doing an Einstein thing here. It's super, super simple. So on the daily, now I can then move this line. So this line I'm moving up. I'm moving up to, my computer's so slow, sorry, to this area and this area. And the assumption is, and in the futures market, you can see this in the order book. In any exchange traded market, you can see this in the order book. You can't see it in the interbanking market, Forex market. You cannot see limit orders. So the assumption is that above certain swings, we have liquidity in the form of limit orders. So the assumption is that there are some stop orders and sell limit orders above these swings. Same below us. Below us meaning below where the market is currently trading. So we're moving this up a little bit. There we are, done. So we see that we were trading in a box, and now the market is asked for a decision. Will pound New Zealand be rejected, or will it continue to rise? And I say fundamentally there's an argument that it may rise. Okay, so what I did is, and you can see the black lines, I bought the first starter position right away, hoping that we would drop down here and drop down here. And I'll tell you in a minute why these price levels. Now the gray box, you may recall, is coming from the daily chart. It's just these pins and then moved over to the right. So I have a visual representation of where I expect liquidity. Oh, statistically, how interesting. The average daily range high is around 194.38. So right in a gray box where above it or within it, I expect some liquidity, a decision by the market. Will the market reject pound New Zealand or accept it in order to trade higher? Onto the 1 hour chart, we can see very strong buyers. Now, I'm not going to give everything away because my traders will be rightfully upset that they paid a lot of money to train with me. So bear with me on that, okay? But a technical analyst would probably see an uptrend here. Very nice. But I need retracements. I absolutely, as a market maker, hate buying directional trades in terms of breakout trading. I am the worst breakout trader on earth because I've been trained for over 22 years to fade the retail trader. Okay, but why am I longing here? My second position goes long here because there was a fair value. And any market is an auction, and an auction is there to find the fair value. At a top edge price, the seller has an unfair economic advantage versus the buyer. At a bottom edge price, the buyer has an unfair economic advantage versus the seller because we're buying too quote unquote cheap. Okay, so naturally a retracement to a fair value 193.28 lets me add my second long position, and the best of the best would obviously be if the market were to retrace all the way to yesterday's low, i.e. Friday's low, because above and below yesterday's high or low we expect what? We expect liquidity, and that is used by us institutional traders to go into fundamentally determined directional trades. Now, of course, we never go just long pound New Zealand. I go long pound New Zealand, and as a hedge, I put in the interest rate spread. But that is advanced trading and nothing for this morning meeting. That's the end of it. I just wanted to show you a chart, and yes, of course, we do chart analysis as well. It takes us a few minutes. I wish you all a very, very good and profitable week. Let's make some pips. And I'm hoping to see you all again next Monday. Thank you for your time, and thanks for dialing in on a Monday morning. I really appreciate that. On to coffee number 2 now, guys. Have a good week. I'll speak to you next week. Jens, thank you very much, sir.
Thank you, James. Let's make some pips means let's make some money. So all the best for that. We have 5 days a week, 5 different traders. If you like the style of Jay, join us every Monday. If you like other styles, just try it out. The other day traders, like I said, 5 traders a week, 5 different styles. So if your time allows that, join us tomorrow again. Greetings from Berlin office. Bye bye.